Okay, so looking at this thing, the mining life cycle has got stage 1, which is just your exploration. Stage 2 is where you're doing your feasibility studies. So you're proving up your reserves, okay, from your resources. And then you actually start building the mine. You order the heavy equipment and you start constructing the mine and you ramp up your production. And then you reach steady state production at stage 4, and stage 5, you're winding it down. Okay, so these are some alternative methods of valuation. DCF is not the only method. You have certain mining codes. In South Africa, we use SAMVAL. We use SAMREC to classify reserves or resources. And then we have SAMVAL, which is a code that governs how we value mining companies. And there are actually 3 approaches to use. It's not all DCF. You can use the income approach, which is the DCF methodology. You can use the market approach, which is use comparable companies and recent transactions, or comps in corporate finance jargon. And you would then use those comps to arrive at a net present value per unit of metal. And then you can also use the cost approach, which is the amount of capital that's been spent to date on this project, minus any degradation or any adverse things that have happened to the deposit. If any of the deposit has been used up, that's degradation as well. So it's like depreciation, if you will, or any adverse thing that has happened to this deposit. Okay. And then you'd add the costs required in order to verify the asset characteristics. Okay, and that's a cost approach. Another cost approach is just to look at the market cap of the company. So there are 3 approaches that you use to value a mining company, not just DCF. And this table is taken from SAMVAL codes. And let's just run through it quickly. If a mining company is early stage exploration, you won't use a DCF valuation because you don't know anything about the deposit. You haven't proved up reserves yet. You don't know enough to place any reliance on your future cash flows in that discounted cash flow valuation. So generally not used. If you're an exploration company, you could use comps, okay, widely used. Let's say you've got a deposit right next door. I know we did this. There was a project that was still in the early phases, and somebody wanted to buy it. And so we looked at a neighboring deposit, and we looked at what was paid by the majority shareholders of that neighboring deposit. And then we assigned a value per ounce or per ton of mineral in the ground. And that's what we used to value the deposit next door. So you can use it, but very subjective, and not, I wouldn't take a project in Africa and compare it to a project in Chile, for example. You have to compare like for like. So it works very well if the deposits are next to each other, and if the characteristics are very similar. So Chile, let's say copper, lower grades than say a copper mine in Zambia, but maybe Chile political risk is lower than Zambia. So, all of these factors will play off against each other. So you need to be very careful when you do this. And then for early stage, you'd use the cost approach. This just makes common sense. So if somebody has spent $1 million to do drilling, okay, and what's the value of what they've done so far? You could say, okay, you spent $1 million and they just want to sell it, so I'll give you $1 million for it. Okay. Or if it's a very promising deposit, I've spent $1 million in it and I want $2 million because this deposit is just the best thing ever. So this is very good for early stage exploration. And then you can see as things progress, I'll leave a link to the SAMVAL. I'll leave a link to the SAMVAL guidelines in the LinkedIn group. And you can see that advanced stage, development, production properties, dormant properties. This is what happened in 2015. So the mine needed to shut down because it was just not profitable. And there you can see how you'd value that asset if you want to sell off that mine. If it's economically viable, economically not viable, and defunct. So, I mean, that's like at the end of its life, or some tragedy happened and you just can't mine it. Many of South Africa's mines today are very deep level mines. There's still gold there. It's just, we haven't got the technology to go 2-3 kilometers down into the Earth's crust and mine it safely and profitably. So we just closed that mine down, but there's still ore there.